What's up, investors? On today's podcast, we are going to be talking about the 5 oil investing lessons most passive investors miss. Now, a lot of you guys are learning out there just like me. I've been investing in oil and gas since 2019 when I went and kicked the dirt out there in northern Texas. Since then, I've come a long way, but I'm still learning like myself. So I put together this list and I just want to talk through it because I think it's a little bit more important to understand the why behind some of this. So you have a more holistic understanding to make the best investment decisions for yourself, of course. And I think the basics is just invest in oil and gas and because it's a bet on crude prices, which it's not. The real story is refining capacity, global supply routes, heavy versus light crude, knowing the difference on that. We're talking about that today. Geopolitics, inflation, or like we saw with the conflict in Iran, right? The Strait of Hormuz. So in this episode, I'm going to break down the 5 lessons and translate them for accredited investors like you out there learning about oil and gas and trying to be better investors out there. Okay, the first thing here, the US can produce a lot of oil and still have high gas prices is a thing that not a lot of people understand out there. They think that, hey, if there is a lot of supply in the area, then the prices are going to be low. This is obviously not true, and which is why where there's a lot of oil out in the Middle East, it's not like you're buying gas for $1 a gallon out there. So the question is, if America produces oil, then why are we still paying more at the pump? If there's a conflict out in the Middle East and the Strait of Hormuz is not allowing any tankers to go through, then why the heck are we paying the price here in America? So going beyond that, oil is a global commodity, and passive investors out there need to understand that energy is not just a domestic supply story. It is a global pricing story. So the United States may be one of the largest oil producers out there, but that doesn't mean that we're insulated from global price shocks in Europe, Asia, California, and other buyers all need the same crude, and the price gets bid up. And this matters because in oil and gas investments, you mainly benefit from higher commodity prices, but the broader economy may feel pressure through inflation. There's a big chunk of energy in that inflation number other than real estate, which we love as investors, and all your basic necessities. It obviously drives transportation and other consumer costs. So the takeaway here is that yes, energy can act differently than stocks, bonds, or real estate, but it is still tied to global supply shocks and not just a U.S. economic condition. We'll talk a little bit more of the dynamic on when it makes more sense to pump more crude in America versus elsewhere. But let's move on to point number 2 here, which is heavy crude from Venezuela or the Middle East matters because refineries are built for that specific oil. So this is something that I learned recently, that oil is not just oil. There's different types of oils out there. There's this light, sweet crude. It's not like you can eat the thing. And there's heavier, sour crude. Now, the United States produces a lot of this lighter, sweet crude because of the shale and fracking that we do. And if you guys don't like that F word, the fracking is generally a newer technology that's been around at least a decade or two, where you put the displacement fluid through the ground and you frack horizontally and you get all that oil to come back, as opposed to the traditional method, which is vertical drilling, and it's like a pipe dream or a Hail Mary whether you get anything. So this is why a lot more modern drilling, which uses fracking, is a lot more consistent in how much it draws out. And from an investment point of view, obviously you need to understand what type of operation they're doing if fracking is involved, but this is where it also produces that light, sweet crude as opposed to the traditional heavier, sour crude, which places like Venezuela or the Middle East are typically known for. Now, we talked a little bit about this bottleneck and where they're drilling for it determines whether it's light or heavy. Sometimes the bottleneck too is how it's refinery. So heavy crude from Venezuela, for example, is not bad just because it's foreign, but it needs a little bit or a lot more of this refinery to be able to handle that type of crude. So it needs actually a lot more refinery and handling to work that type of crude. That's why you're seeing a lot of the refineries out in Houston or Texas area where that crude is obviously coming up from Southern America needs to come through those facilities. And that's where the problem is dependency. If a refinery is built for heavy sour crude, but that crude gets disrupted by sanctions or the leader of the nation disappears in the evening, this is where you can create some type of instability in, yes, you can take the oil, but you need to refine it too. And typically that's done on the America side and you consume it here. So obviously this will create mismatch between the supply and create supply stress and make the gasoline prices more sensitive to these types of global events. So just because you hear, hey, we're taking Venezuela oil, doesn't mean we're fully ready to take it all the way and all the way to refining too. Again, this is not the time or place, but we talk about the subject matter here on this podcast. But that's actually one of the reasons why I think Venezuela was such a big ideal target, because we had the refineries down in Texas to be able to handle this heavier crude. Now, point number 3 here, this is a little bit more macroeconomic, that oil shocks can quietly affect interest rates, real estate, and other private markets. Why? Because oil is the lifeblood of any economy. And higher oil prices not only hit the gas pump and get the guy who is going on his road trip upset, and obviously politically puts all pressure on the candidates out there, but it feeds into transportation, manufacturing, and the cost of goods. So companies are less able to go and do an expansion, to use a simple case, and expansion in many means. So this definitely, if oil prices are high, it actually pulls back a little bit. And what I like about investing in oil and gas, what I just mentioned, there's a bit of a self-correcting mechanism. If the economy gets too hot and therefore they can pay higher for prices of oil, that it goes up and up. But then if the supply, there's not enough supply, but if energy prices stay higher, inflation can stay sticky, and that can keep interest rates higher for longer. So here, the point I want to make is oil does not stay in the oil market. For a passive investor, this matters because portfolios are indirectly exposed to energy whether you know it or not. To me, that's why I'd rather be playing in it. And I'm not going to say here, I'm not a financial planner, so I begin to tell you whether you should have 90%, which I certainly don't think, or 10% or 25%. I actually like it, do it for myself to get just enough to mitigate my taxes first, and then maybe a little bit more to have a nice little portion of my portfolio. I definitely am long-term bullish, and we'll talk about many times on this podcast of other reasons, but I think we are all somewhat bullish people listening to this podcast. But other reasons, higher oil can affect shipping costs because of transportation, fuel costs, construction costs, the airlines, how they do the fuel surcharges, how mitigated that unknown in their P&L there, I think is clever. Interest rate expectations with higher oil, you'll probably see an environment that's a little bit more conducive to higher interest rates because it needs to cool off that amount. And then obviously that really impacts real estate financing, which we've acquired over $2 billion of real estate in our company. If you want to kind of get more involved on that side and what we're seeing else out there in private equity, you can go to thewealthelevator.com/club. But this all ties together. And this is why, as an investor myself, I've come up with through commercial real estate, buying rental properties, buying dozens and dozens of apartments. But this is where I'm starting to realize that, wow, oil is a big part of that thing that wealthy people invest in, along with apartments and also private equity, private credits in there too, and how it's all plays together. And I don't know what's going to do well, but I do know that the smart people diversify because you never know what is doing well. And the contrarian investors do well because they look what's been beat up and they buy that. And they don't rush to the things that are sexy and hitting headlines all the time. So maybe I'm just saying that if you have a big portion of your portfolio in oil, maybe you need to pause and understand that other parts of your portfolio also has exposure to it too. But again, I'm not going to say what that minimum amount of oil and gas exposure, which is a commodity, one should have. Everybody is different here. Not a financial planner. But if you'd like to jump on a phone, we can talk about your situation, just chit chat, get to know each other a little bit better. I'm always here to have that first onboarding call with people. The next thing I wanted to go over is point number 4, which is geopolitical risks is a part of the underwriting on these things. We've seen this with Iran, doing the blockades in the tanker Hormuz, the tanker shipments, and then how the big disruption in Philippines or Korea or Japan with oil, a lot of their oil comes from that region. And even with America being a domestic producer of oil and somewhat of a net exporter, so we probably make more oil than we need out here, we're still impacted because of this global trade of oil, which is essentially energy. You may look into oil and gas investing as a way to mitigate taxes and somewhat of a cash flow strategy, but just remember it's tied to real world events, wars, sanctions, tanker routes. And it does not necessarily mean that you should avoid energy, but just understand the risks. I still like energy because I like to invest in things that I think that are going to be 10 years in the future. To me, I see us increasing our needs for energy. The big issue I see is nuclear energy coming online, but we know what an F word that is, and how people don't like that. But I think it's rather safe. But until then, it's oil, right? Is really the only thing. The green energy is not going to get to where we need to be. But that's the point. Geopolitics, these things, they have a real impact on this stuff. One rule I have, me and my core investors, we talk about this a lot, where I personally don't want to invest in anything medical because I don't know anything about medical. I'm not a doctor, and I don't have the insight into making educated bets on a world that I don't have an understanding. And in that world, a lot of it has to do with drug companies and who's in there lobbying for themselves. Whereas I don't have that same uncertainty with energy. I can kind of see where the puck is going here. You may not agree. By the way, another thing that I stay away from on angel investment side is consumer product goods, CPG, because I tend to fall in love with soft drinks, and we know those things go down by the wayside all the time. Just like they say, never invest in restaurants because those are typically the worst investments ever. But anyway, to the last point here, to kind of close things out, energy can be attractive when investors are scared, but only at the right cost basis, right? So I was kind of mentioned this earlier, like most unsophisticated investors, they go and look at what's been performing well the last 5 or even 10 years. Depending on when you're listening to this in 2026, the S&P 500, which is primarily a bunch of AI tech stocks, have been on fire, right? You guys all know the friend who has a lot of NVIDIA, like maybe 20 or 40% of NVIDIA or Tesla, right? And they think it's a great company. It might be a great company. I actually like those companies myself, but I don't think it's proper to have that much of your own personal net worth into one company. So same point comes here with oil and gas, right? You are playing with a commodity that for the most part, everybody needs, and for the foreseeable future until nuclear comes online or something else, it is going to be in high demand. But you need to look for those dips and those geopolitical things that come up that create those buying opportunities. So for example, when the whole Iran issue came up in, I'm going to say early 2026, we jumped on it and we got into some projects that were closing up, and we knew what was going to happen, right? The projects that would be coming up the next month or the next quarter, their underwriting for price per barrel skyrocketed. I think in early 2026, you were finding some deals underwritten with just $55, $60 per barrel. And then later on in the year, you're looking at $80, $85 a barrel. And so, yeah, they all on the surface, they all say the same thing, projected returns, blah, 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 blah. But when I look at deals, I want to look at what are the underlying assumptions. Just like when you invest in an apartment complex, you want to look at, for example, what the reversion cap rate is on a deal. If a deal is showing 100% return in 5 years, but assuming a 5% reversion exit cap rate, I want to underwrite it maybe with a 5.5. But that's obviously going to bring the projections down. So there's a lot of operators and funds out there. They all use different projections to get the magic number at the end of the day. Your job as an investor is to figure out and somewhat normalize everybody's deal with the same assumptions to be able to then compare apples to apples. For example, all Class B apartments in southern Fort Worth, Texas, underwrite them with an exit cap rate of 6%, right? And then the other ones that aren't, normalize it to 6% and then see the projected returns at the end of the day. Same concept here that I'm talking about with oil and gas. And what makes it easy is there's not too many. It actually is a little bit easier to underwrite these oil and gas is because there's actually less inputs than you have with a multifamily apartment where you have the full P&L sheet and rent rolls and all of that you can drastically manipulate the numbers and change what you would calculate at the end of the day. Sometimes you can get this, it's a roundabout way, but you can ask what is the per price of oil assumption is, but you can ask what is the break-even price. So break-even price is at what price does oil need to hit for me to not lose money? It's like, for example, some of them are like $40 these days. So that means if the price of oil comes all the way down to $40, which I don't think is going to be the case. It could happen, right? We're investing, right? There's always risk in anything. But if it comes down to there, then you at least break even and get your money back at that point. Other things that you may want to ask is like, how soon does production begin? When does my cash flow start? What other tax benefits are available? Some deals that look better with cash flow, what they're doing is they're blending pre-existing wells that have been producing, which sounds great, but you don't get the intangible drilling costs. So you kind of trade off those tax benefits. So it's important if you're going into oil and gas, you need to understand why you're investing. Is it either for the cash flow or is it for the tax benefits, intangible drilling costs in particular? You got to be careful. It's a bit of a cat and mouse game here. So I think you need to just ask the question, right? But I do think energy can belong in anyone's passive investment portfolio. Certainly it is in mine, but only when you have the right structure, operator, tax profile to hitting your personal goals, which is different for everybody, and understand a little bit of how the deal is underwritten. Then I think you can kind of move forward. So if you guys are interested more in this and also want to connect with myself, you can go to thewealthelevator.com/club and shoot me email Lane@thewealthelevator.com.